Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today we're diving into Oscar Health, ticker OSCR. This is a deep dive that, I have to say, requires us to navigate some of the most complex, high-stakes material we've ever covered. We're talking about the U.S. healthcare system. And Oscar is this small, relatively young company trying to, well, revolutionize a hyper-politicized, multi-trillion-dollar mess.
And that context is absolutely crucial. I mean, you can't understand Oscar without understanding the world it lives in. When we look at the source material, the volatility is just immediate. The U.S. healthcare sector isn't just large. It is the third largest sector in the S&P 500.
The third largest. Wow.
And this whole sector is currently in a state of, let's call it high alarm. It's grappling with these fundamental systemic challenges. So our mission today is really to determine if Oscar, which is fundamentally a technology company born out of frustration with this outdated system,
Right.
can it execute a strategic path that overcomes these massive, immediate political and financial risks to deliver on a potential 10x return by 2030.
That 10x goal is so ambitious, but it feels entirely dependent on surviving just the next 2 years. Let's start there. Let's start with the overwhelming problems facing the entire healthcare infrastructure right now. Analysts are calling this a tough cycle, and the pressure on carriers seems immense.
It's a structural squeeze. That's the best way to think about it. The pressure comes from two primary angles. First, you have sustained rising utilization.
People are just using healthcare more.
Exactly. And second, pervasive cost inflation. On the utilization side, we are dealing with a huge backlog effect from the pandemic. People deferred necessary surgeries, preventative screenings, routine care. And now those issues are presenting later, and they're often more acute, more complicated, and of course, much more expensive.
That deferred care is then compounded by demographic realities that, well, they aren't slowing down. We have an aging population requiring higher levels of complex managed care, and that's combined with the continuous growth of chronic diseases that require these costly ongoing treatment protocols.
It's a perfect storm.
Yeah, it really is. More people needing more care, and they're needing more complex care. That just leads to higher payout spending for insurers right across the board.
And this spending is happening amidst intense cost inflation. We're talking about labor inflation for skilled medical professionals, nurses, doctors. We're talking about specialty drug costs that are just exploding, particularly with new gene therapies and biologics. And then there's the continuous need for investment in new medical technology. So insurers are getting squeezed simultaneously by volume and by unit cost.
Which all leads directly back to the systemic failure that Oscar CEO Mark Bertolini identified. He argues that the entire U.S. healthcare system was fundamentally built 80 years ago.
80?
An 80-year-old foundation for a modern problem. Exactly. And he says it contains built-in inflation because the end consumer, the person actually receiving the care, they lack any price sensitivity regarding their insurance benefits.
And this is the core diagnosis. I mean, if you, the consumer, are insulated from the true price by a fixed copay, you have zero incentive to shop around for a cheaper MRI or question the underlying cost structure.
The economic feedback loop is just broken.
Completely broken. So costs soar because the patient's demand curve is inelastic, and there's no mechanism to enforce any kind of price discipline.
That is the perfect backdrop for Oscar's narrative. They were founded to introduce technology and consumer empowerment to fix that very flaw. But before they can even get to the solution, they have to survive the immediate existential risk hanging over their heads. Let's unpack that. The core immediate risk, which is almost entirely political, and it threatens Oscar's business model at its very foundation. We're talking about the ACA subsidy overhang. This feels like the single most critical point for any investor looking at this stock.
It is the ultimate gating factor. I mean, nothing else matters if this isn't resolved. Oscar's entire strategy is built on serving the individual market, primarily through the ACA marketplace. And that means they are entirely dependent on government subsidies through the Affordable Care Act to make their products affordable to millions of their members.
And those enhanced subsidies, the ones that significantly lowered premium costs for low and middle-income Americans, are set to expire in 2025. This looming expiration creates a massive financial cliff.
The consequences, if Congress fails to act, are, well, they're staggering. Premiums for millions of people currently receiving those subsidies are projected to increase by a massive 114%.
114%. That's not a marginal rise. That is the difference between an affordable monthly payment and a bill that instantly makes coverage unattainable for a family.
Absolutely. And if the subsidies vanish, affordability disappears. And the sources we've seen project that up to 8 million people covered by the exchanges could lose their insurance entirely.
8 million people. So for Oscar, a company that has grown to 2.1 million members, largely by serving this subsidized market, the failure to extend these subsidies would be an existential threat. It threatens their ability to retain customers, to scale, to even exist.
And Bertolini, the CEO, he provided a really specific, compelling anecdote illustrating this risk's real-world impact. He noted that a significant population, 27% of American farmers, rely on the ACA for their health coverage.
Okay, that's a demographic I would have immediately thought of.
Right, and he detailed the financial shock. A farmer whose average premium is currently subsidized down to, let's say, $75 a month would suddenly fly a bill closer to $300 a month.
So an extra $225 a month.
Yeah. And you extrapolate that over a year, you stack it against a tight agricultural income, and it can severely impact their ability to afford essential business inputs. Fertilizer, seed, even putting food on their own table. The economic displacement is just profound.
Which is why the political volatility is so intense right now. I mean, we saw reports earlier in the year that Democrats were reportedly willing to shut down the government entirely unless Republicans agreed to extend those enhanced subsidies. They recognized the catastrophe this would create.
The stakes couldn't be higher.
We also can't ignore the election cycle, which drove Oscar's stock down earlier in 2024. Just the threat of a potential ACA repeal or even a severe curtailment, doesn't matter how feasible it is, that's enough to inject crippling uncertainty into the market.
It is.
Yeah.
However, there is a silver lining here and a political insight in the materials that suggests the tide may be turning in Oscar's favor. The analysis strongly suggests that Republican leadership and the next administration may ultimately, and this is the quote, cave to Democrat demands and extend these subsidies.
That sounds completely counterintuitive. I mean, given the years and years of political opposition to the ACA. So what is the fundamental political calculus driving that predicted shift?
It's pure demographics and constituent reliance. It's not about ideology anymore. It's about votes. Bertolini highlighted a powerful statistic. Roughly 75% of the people currently enrolled in the ACA marketplace and benefiting from these subsidies reside in states that voted Republican.
75%?
75%. These are not the coastal, traditionally perceived ACA strongholds. The policy has quietly taken root in rural communities. It's supporting farmers, small business owners, people transitioning jobs in red states.
So if the subsidies are allowed to expire, the immediate backlash of 8 million people losing coverage primarily lands in Republican-held districts.
Precisely. The political pain would be concentrated in their own backyards. And Democrats have successfully used the ACA as a highly effective campaign issue, framing the extension of subsidies as protecting affordable coverage for the average working family. If Republicans want to avoid losing that public relations battle and alienating a critical voter base in key competitive states, well, extending the subsidies just becomes the pragmatic, long-term strategy.
And that resolution would immediately deliver the pricing clarity that Oscar so desperately needs to scale confidently.
That's the key, pricing clarity. Everything flows from that.
Okay, so that political risk is the macro existential concern. But while waiting for Congress to sort that out, Oscar is also grappling with some significant short-term financial strain. And this brings us to the operational turbulence we saw in the Q3 2025 financial results.
Yeah, the consensus is that 2025 and 2026 will be transitory years across the industry. It's not just an Oscar problem. It's because of the compounding pressures of inflation, that rising utilization, and all this regulatory uncertainty. We saw this manifest very acutely in their core metric, the medical loss ratio, or MLR.
Oscar's MLR spiked significantly. I mean, it went from 84.6% in the previous year to 88.5% in Q3 2025. That's a 3.9 percentage point increase year over year. For an insurance company operating on thin margins, a jump like that is enormous.
It's huge. And that spike was directly caused by the factors we just laid out. The increased patient utilization as deferred care finally caught up, and this persistent higher medical cost inflation. They simply paid out significantly more per member than they underwrote for.
And the consequence on the income statement was brutal. Operating losses for Q3 2025 increased by a massive 167%. This short-term financial picture explains precisely why Wall Street analysts are so skeptical of the long-term growth narrative right now.
You can't ignore 167% acceleration in losses. You just can't. However, management has a firm tactical strategy aimed at getting the company back to profitability. They have to control their risk exposure for 2026.
So what does that counter strategy actually look like?
It's a clear plan. They're going to increase prices across their plans in 2026 by a pretty significant margin, somewhere between 10 and 20%, depending on the specific plan and the region.
Okay, a big price hike.
A big one. They're combining those necessary price hikes with an expectation that the utilization spike will start to stabilize as that deferred care backlog finally clears.
So the goal then is to use higher premiums to drive the MLR back down into a profitable range, offsetting the expected costs. And management has guided for a firm return to profitability in 2026.
Correct. They are using old-school pricing tactics to survive the transition, which buys them time for their new school technology to deliver the structural efficiency required for that long-term growth. The crucial pivot point now is whether that technological solution is unique and powerful enough to justify the massive long-term ambition.
All right, let's pivot to that. Let's talk about why this company is compelling in the first place. The core bull thesis. It's that Oscar is a technology-first disruptor. It's a software company that just happens to sell health insurance, and that DNA is supposed to provide an insurmountable operational advantage.
That DNA goes right back to the founding story in 2012. It was founded by a computer engineer who experienced firsthand just how agonizingly complex the healthcare maze is. The company's whole genesis was built on solving that user frustration, with a mission to make a healthier life accessible and affordable for all.
And the key to achieving that was fundamentally avoiding the mistakes of the past, specifically what the sources call legacy thinking, and the outdated technology that constrains all the older, larger carriers.
And this is more than just marketing fluff. When you look at the giants in the industry, their technology infrastructure is fragmented. It's often a patchwork of decades-old mainframes stitched together with modern acquisitions. They spend vast sums just trying to maintain compatibility.
It sounds like a nightmare.
It is. Oscar, by contrast, was built from a fresh, clean slate, using proprietary cloud-native software architecture that was designed from day one to handle highly customized individual data.
Okay, but this structural decision has to translate directly into demonstrable operational leverage. Otherwise, the entire bull thesis just collapses. What are the key metrics that prove this efficiency edge?
We look directly at the SG&A ratio, sales, general, and administrative costs. Despite that painful MLR spike in Q3 2025, Oscar demonstrated its operational efficiency because revenue grew so much faster than their administrative costs. The administrative expense ratio actually decreased from 19.0% to 17.5% year-over-year in Q3 2025.
So wait, even while losses were ballooning because of higher medical costs, they were getting more efficient on the back end?
That's exactly right. That 1.5-point drop is significant. It means they are scaling efficiently. Revenue grew over 23%, but their SG&A expenses grew only 13%. That gap, that 10-point gap, is the operating leverage. It demonstrates that the cost to process each new member is shrinking dramatically.
Oh, what's driving that?
The most stunning evidence of this technology edge is their automation rate. This is the statistic that should make every legacy carrier worry. Oscar processes an incredible 98% of all insurance claims automatically, without requiring any manual human review.
98%. That's nearly flawless automation. The difference between 98% and the typical industry average of around 80%, that's the entire game.
It is the ultimate source of their potential cost savings. Just imagine a typical competitor manually reviewing 20 out of every 100 claims. Oscar is reviewing just 2 out of 100.
How do they even do that?
It's their cloud-native platform. They use advanced machine learning and AI for claims triage. The system is designed to identify and process standard, clean claims immediately. It only escalates claims that have unusual coding or complex circumstances to the human reviewers.
So if they can maintain that 98% rate as they scale to millions more members, the administrative cost savings compared to competitors will be, well, astronomical. They can staff up with drastically fewer people and undercut competitors on premium pricing in the long term.
This is the argument for why they can achieve the best SG&A ratio in the industry over the next decade. Efficiency is the first half of the equation. The second half is customer engagement, which they use for crucial cost control.
So how does the technology ensure high engagement?
It starts with their industry-leading mobile app. Oscar boasts adoption rates that are typically 10 times the industry average. We're talking 30 to 40% adoption among their member base. They've succeeded where others have failed by making the application genuinely useful, simplifying that complex system the founder initially hated.
And the core value proposition within that app, the thing that drives both engagement and cost control, is the offering of free and unlimited telemedicine.
That telemedicine perk is the hidden efficiency mechanism. The primary value isn't member convenience, although that's a nice benefit. It's cost control for the plan. If Oscar can support 10 virtual visits via the app, and just one or two of those televisits prevent a member from escalating their care to an emergency room visit.
The savings are massive. An ER visit can cost tens of thousands of dollars. A virtual consultation is a tiny fraction of that.
Exactly. By steering members to virtual urgent care, virtual primary care, or mental health resources, all delivered seamlessly through their app, they avoid those massive, expensive, and often unnecessary ER payouts.
And those averted costs translate directly to a lower medical loss ratio over time.
Right, which in turn allows them to offer those highly competitive premiums, like the $0 deductible plans we see them using in new markets.
And finally, they stabilize their competitive position by being tactical about their networks.
Yeah, they stabilize their cost base by building their own networks. They negotiate directly with best-in-class hospital systems to secure good rates. They are not just accepting every doctor in town, they're selecting partners who provide best value, which allows them to control unit costs and ensure premium stability in this highly volatile ACA market.
Okay, so the technology story is complete. Low cost through that 98% automation, high engagement through the app, and price stability through strategic networks and telemedicine. Now, let's transition to how they plan to translate that competitive advantage into massive member growth.
The path to 10x requires more than just efficiency. It requires a new, massive market. And this is where CEO Mark Bertolini's vision for systemic reform connects perfectly with what's being called the ICHRA revolution.
Bertolini's argument is foundational. He says fundamental reform requires changing incentives by putting consumers in charge of buying the product. He believes that giving consumers cost control eliminates the gross inefficiency in the system.
His mechanism for achieving this is the qualified account, like an HSA or, more importantly, the ICHRA, which acts as the doorway for funds. This vision directly frames the exponential growth engine Oscar is banking on, the Individual Coverage Health Reimbursement Arrangement, ICHRA.
Let's dedicate the necessary time to ICHRAs. Because they are so central to this 10x thesis, we need to be crystal clear on what they are and why they're seen as revolutionary.
Okay, so ICHRAs are a post-Trump era regulatory change that allows employers to offer an alternative to traditional group plans. Instead of the employer picking one or two insurance products for everyone, the employer sets aside a pool of money, a fixed budget, a defined contribution. The employee then uses that budget to individually shop for their own preferred plan in the individual market.
So the employer is defining the budget and the employee is defining the benefit. It shifts the administrative burden and the risk of choice onto the consumer.
Exactly. And this is revolutionary primarily because it solves the biggest pain point for small employers. ICHRAs serve as a crucial on-ramp for benefits for the estimated 71% of small employers, those under 50 employees, who currently find traditional group insurance too costly and complex to administer. ICHRAs give them a fixed, predictable budget to offer a really valuable benefit.
But the opportunity isn't just limited to small businesses, is it? They also serve as an off-ramp for mid-size and even large companies that are just tired of the annual price hikes and the administrative hassle of managing complex group plans.
That's the tectonic shift. The market potential here is why it's called a revolution. The projection is that 17.5 million working Americans will transition from traditional group plans to ICHRAs over the next 5 years.
17.5 million. That number represents a colossal, sudden migration of individuals into the exact market segment Oscar was specifically built to serve.
And that's why Oscar is so perfectly positioned to capture this shift. It's because of their technology. Oscar was the first health carrier to pivot aggressively and enter the ICHRA space. Their clean slate technology platform, built specifically for the complex individual enrollment process of the ACA marketplace, gives them a massive head start over legacy carriers whose ancient systems are still optimized for group benefit sales.
But this growth is heavily mediated by insurance agents. They have to be incentivized to push this product. So why are ICHRAs so highly attractive to agents?
It creates a predictable and very profitable structure for them. Agents who facilitate this transition retain what's called agent of record status, or AOR. They receive the crucial $25 PMPM per member per month commission from the individual carrier, like Oscar, for every single employee who enrolls. This is a stable, recurring revenue stream for them.
And they get paid separately by the employer for the consulting work of setting up the budget and ensuring compliance. So they're double dipping in a good way.
Correct. The agent receives a broker fee from the employer for managing the complexity of the ICHRA setup, which is often easier than negotiating group plans, but it does require specialized compliance knowledge. This dual revenue stream upfront fees from the employer and recurring PMPM commissions from the carrier makes ICHRAs a highly compelling product for agents to sell aggressively. And that, in turn, fuels Oscar's growth potential.
Okay, so beyond the ICHRA wave, Oscar is also focused on aggressive current market expansion. They have a 2026 open enrollment period, or OEP, strategy.
Yeah, they currently have 2.1 million members, which is a fantastic base, but they only operate in 18 U.S. states. They recognize they have to dramatically expand their footprint to hit those 10x targets. The plan is to increase their total addressable market by 60% by entering 150 new markets by 2027. That is a highly ambitious expansion schedule.
And to make a bold impact in these new markets, they're using aggressive pricing that leverages that low SG&A ratio we talked about. Our sources highlight some extremely competitive plans.
The pricing strategy is surgical. It's designed to steal market share immediately. They are offering $0 bronze options in key areas, like parts of Michigan and Memphis, that feature a $0 medical deductible.
A $0 deductible on a bronze plan, that's rare. They usually have sky-high deductibles.
Exactly. It's the Bronze Elite Plus PCP Saver Plus plan. It immediately removes that financial barrier to initial utilization. And they are being equally aggressive on the higher tiers, offering $0 gold plans in several Texas and Florida markets. Gold plans are supposed to be expensive, low deductible options.
Offering a $0 premium gold plan is a massive competitive statement. How can they even do that?
They can only do it because their superior efficiency allows them to budget the cost differently. And furthermore, these plans feature highly attractive copays, like primary care visits for as low as $5 and generic prescription copays as low as $3. They are betting that their technological cost control mechanism will offset the lack of upfront premium revenue.
And they're also strategically using co-branding to facilitate seamless transitions for members who are leaving competitors.
This is market share theft done intelligently. For instance, in Nebraska, they partner with Bryan Health. In Charlotte, they have co-branded plans with Atrium Health. Now, since Atrium was part of Aetna's network in 2025, Oscar can offer a seamless one-click migration path for Aetna clients who are looking for new coverage. It ensures they can keep their existing doctors. This is a very surgical approach to leveraging their negotiated networks to capture customers leaving the giants.
So the stage is set with these massive growth engines, but they still have to overcome the political and financial risks to realize that potential. This leads us to the 10x targets.
The intense volatility and that Q3 financial turbulence, the 88.5% MLR and the 167% loss spike have profoundly depressed expectations on Wall Street. This leads to the critical analyst disconnect.
The weak expectations for 2026 are highly telling. Analysts are projecting extremely weak results, including an expected 5% revenue decline for 2026.
This just signals massive skepticism. Analysts fundamentally do not believe Oscar can hit its guidance for profitability in 2026, nor do they believe the company can successfully navigate the ACA political risk and the rising utilization pressures without significant revenue contraction and member losses, especially after announcing those 10 to 20% price increases.
And yet, this overwhelming market skepticism is precisely what creates the massive opportunity, according to the investment thesis.
That's the key takeaway. The market is pricing the stock as if the failure scenario is likely. This depressed valuation trading at a very low price-to-sales ratio creates the potential for dramatic appreciation. If the political climate stabilizes and Oscar's technological efficiency continues to compound, then beating analyst expectations is the best path to outsized returns.
The stock has been intensely volatile, but the investment case explicitly outlines a high-risk, high-reward path for Oscar to 10x by 2030, which they model at a 917.4% return. For this to be achieved, they have to hit two simultaneous, highly ambitious targets.
The first is membership scale. They must transition from 2.1 million members to achieving 6 million members by 2030. That requires maintaining a breakneck pace of a 24% compound annual growth rate over the next 5 years.
That 24% CAGR is incredibly steep. How much of that has to come from the ICHRA capture versus simply winning market share in new geographic regions?
While geographic expansion into those new 150 markets is crucial, the ICHRA capture is the exponential force. It has to be. They must capture a significant chunk of that 17.5 million working Americans expected to transition to the individual market. If they successfully use their technology to dominate that transition, the 6 million member target while still difficult, becomes plausible. They are betting on the market coming to them via ICHRAs, given their first-mover advantage and technological readiness.
The second target is margin. The health insurance business is notoriously thin, but 10x returns demand high profitability.
They have to achieve a sustained 5% operating margin by 2030. Considering their current state of accelerating losses, this requires a fundamental transformation driven by the superior efficiency we discussed. They have to ensure the MLR stabilizes in the low 80s. And that SG&A ratio, thanks to that 98% automation, must drop significantly lower than the current 17.5%. It probably has to get into the 12 to 14% range to yield that robust 5% operating profit.
And if they manage to hit both targets, 6 million members and a 5% margin, the financials are just staggering.
The model projects total revenue reaching $57.7 billion by 2030, generating a net income of $2.28 billion. That is the necessary financial outcome to support the 10x valuation required for a rapidly scaling, efficient health carrier.
But let's challenge the premise. Given all the risks and the current financial pain, what if they only partially execute? Is there still a substantial case if they fall short of that blue sky 10x target?
Yes, and that's important. The investment analysis included a more modest scenario. This premise assumes slower than expected ICHRA adoption and only moderate success in their geographic expansion.
Okay, so in that modest scenario, what are the revised targets?
They achieve 4 million members by 2030, so they miss the 6 million goal, and they realize a slightly lower 4% operating margin.
Even in that environment where they are unable to onboard members as quickly as hoped, the upside is still substantial.
It remains a multi-bagger return. The 4 million member, 4% margin scenario still yields a net income of about $1 billion. In this context, the upside is projected to range between 163% and 251%. This suggests that while the 10x target is high risk, the underlying technology in the ICHRA market shift provides substantial potential returns even with moderate execution. But again, provided the political headwinds stabilize.
In summary, the setup for Oscar is a crucial bet on technology overcoming politics and legacy systems. It offers a rare, high-risk, high-reward path for patient long-term investors. But everything, absolutely everything, is conditioned on that ACA subsidy overhang resolving favorably.
When we look back at the arc of this deep dive, the narrative is built on a clear tension. On one hand, Oscar's foundation is superior disruptive technology. That's evidenced by the falling SG&A ratio from 19.0 to 17.5%, and that astounding 98% claims automation rate. That efficiency is their only path to sustained profitability.
And that technological edge is what positions them perfectly to capture the two massive growth drivers defining the next decade: aggressive, competitively priced geographic expansion, and, more importantly, the revolutionary shift in employer benefits via ICHRAs. The ICHR market, serving as an on-ramp for 71% of small businesses, aligns perfectly with CEO Bertolini's vision of empowering consumers.
However, the short-term financial reality, the Q3 MLR at 88.5% and the 167% loss spike, and the acute existential political risk of 114% premium spike from the ACA subsidy expiration, those remain the massive challenges. If that political conflict is resolved favorably, which the political analysis suggests is likely due to strong red state reliance, the path to achieving 6 million members and a 5% operating margin is realistic, and that could deliver returns that will crush current weak analyst expectations.
So here is the final provocative thought we want to leave you with. Given the projection that 17.5 million working Americans could transition from traditional group coverage to individual plans via ICHRAs in the next 5 years, how profoundly will this consumer empowerment giving employees the budget and the choice fundamentally reshape the relationship between employers, employees, and health carriers over the next decade?
It suggests a world where the power shifts irrevocably away from the rigid, monolithic legacy group insurers and toward nimble, technology-focused platforms like Oscar that are designed to serve the empowered individual. The question is, are you ready for that revolution?
Risk defined, portfolio protected.